Hello and welcome to the Mutual Fund Show. I'm your host, Niraj Shah, and hope for all of you, the week thus far has been okay. Well, the idea of today's conversation is to try and clear some confusions, right? Because a lot of us are confused investors. The industry itself has over 10 categories in equity, multiple categories in debt as well, and selecting the right category of mutual funds can be much more than just plain difficult. And if investors thought until 2018 that equity was complicated and debt was straightforward, I think post 2018, post SL Group moves, we've known that debt too can be very, very complicated and cumbersome to understand. So, is the Japanese approach of being a minimalist in life applicable for the mutual fund industry as well? More importantly, can that yield hard, tangible returns? And is there a better and a safer way of investing into funds at large? Well, let's try and talk about that. It's a bit of an esoteric topic, but it'll be interesting to talk about that. Start off the show with Pratik Oswal. He's head of passive funds at Motilal Oswal Asset Management Company. He joins us right now on the show. Pratik, good having you. Thanks so much for joining in. The skeptic would say that I would expect Pratik Oswal to anyway say that because he heads the passive investment at Motilal Oswal. So why wouldn't he be in favor of minimalism and passive investing?
Yeah, thanks, Niraj, for having me on the show. So, basically, I think this comes from more about concern than anything else today. So there is a lot of complexity in the marketplace today. There are, as you said, thousands of mutual funds, hundreds of debt funds, and even the categories, have gone up in a very big way. So the idea behind this approach is to actually keep things very simple. There's a saying, the less you have, the less you have to worry about. And I think that is what is all about minimalistic investing. In fact, what we've seen, at least for what the data shows, and this goes back, all the way to, say, Harry Markowitz, who's a Nobel Prize economist. What he says is that portfolio doesn't really need more than 30 stocks. I think the benefits of diversification stop after, say, the 35th or the 40th stock. So the idea behind this is that, do you really actually need 5 to 6 to 10 to 15 mutual funds? Because today the concern is that, a lot of people are holding a lot of mutual funds. I have spoken to investors, who have 10, 15. I have actually spoken to investors who have 50 mutual funds. So is that something which really needs to be looked at, number one? And number two, because you have so many funds, the problem is that, investor looking at a 10-year perspective is checking his NAVs every day. And also, he tends to chase returns a lot, which is what I think is a big concern in the industry as well. So, which is why I think this concept of minimalism comes in. Ideally, think about it by just looking at hard science. You ideally, at least what I'm saying, is that a DIY investor today should be okay with one equity mutual fund in India, one abroad, maybe one gold ETF, and probably one GSEC or one liquid fund. I think that is good enough for him to have on an asset allocation basis.
Okay, we'll get to this, what kind of assets and the point that you just mentioned in a bit. But first, I was looking at the presentation that you made, and I would urge you to take us through those numbers as well, the combination of the strategies and the return profile. Because, over 5, 10, 15 years, I think you guys have gotten the returns of what the Nifty 500 TR index, growth plus gold, and a moderate and a conservative and an income strategy. Can you take us through that?
Sure, absolutely. So just before that, I wanted to talk about asset allocation. I think today asset allocation has become a gold standard of investing. I think the reason why it's gotten there is because asset allocation is actually the antonym or the opposite of market timing. So the whole idea is to spread your bets in multiple asset classes because you don't know what will do when. So I think the reason why asset allocations work is because people have realized over the last 4 or 5 decades that market timing does not work, which is why I think, and at least what the data shows is that, 90% or maybe close to 90% of your long-term objectives of investing comes via asset allocation and less about fund selection, which is why, we've kept fund selection super easy. If you look at some of our presentation, we can see that we've chosen 4 asset classes. We've chosen one Nifty 500 fund, which basically captures the entire market, India's market. 96% of India's equity is in this one fund, and I think it's a pretty good fund to have. Then there's international as well. So I think we've taken S&P 500, which is pretty good broad-based equity fund. It's also a very global fund because a lot of its sales are coming from their operations outside the US. So we've taken that. For the debt side, I've taken the Crystal 10-year gilt just to keep it super simple. Yes, it might be a little bit risky at this point of time because yields are pretty low, but I think from a long-term perspective, it's a pretty good index. And for the gold, I think gold is actually a pretty interesting asset class. It's done pretty well, but I do think that it is actually a great hedge for when equity does badly. So whenever equity does badly, at least over the last 15, 20 years, gold has done well. So I think it reduces the volatility. So this is the asset class that we've taken for the portfolio.
Okay, so before we get to the numbers then, which is what I asked you, Pratik, is there a percentage allocation that you're doing to these? Because I remember a webinar that I had with Ramdev, and it's okay to have different thoughts than Ramdev, right? Because he thinks equities all the time. But he said, he was talking about Buffett's experience and his own thought about why gold, because it's a non-productive asset, should not be a very large part of the portfolio anyway. So when you're looking at these 4 asset classes for a typical investor through the mutual fund route, what is the percentage allocation? Is there a standard or is it very individualistic?
Yeah, so ideally, the way I see it, there are typically 2 types of investors. One is aggressive and one is, say, conservative. I do think that everyone should invest basis on their risk profile, and a lot of people will not be able to take that much volatility, especially when you look at the current time. So I do think that a lot of investors should figure out what is the risk profile and invest accordingly. With regards to gold, I actually completely mirror that perspective. I'm also a huge Buffett fan. So I do think gold is an unproductive asset class, but I do think that, and in terms of returns, honestly, if you look at it from a long-term perspective, hasn't really done that well. But I think it's more of a volatility sort of hedge, sort of a example. But I think coming to talking about, I'm sorry.
Yeah, I thought you were coming on to the strategies and the return profiles and how conservative versus a growth investor or aggressive investor should invest.
Yes, exactly. Yeah. So a growth investor would have basically a lot more allocation towards equity. So maybe a growth investor would have close to 60 to 80% of his investing in equity, whereas a conservative investor would have close to maybe 50 to 60% in debt. So that's how you would sort of allocate these 2 investors and these 2 strategies. And if you look at, and the idea behind these 2 strategies is also, I think it's important to understand that rebalancing is extremely important, and that is where really discipline comes in. So ideally, most investors tend to become, I think, conservative during bad times and aggressive during good times. That does not work for this strategy. Ideally, most investors today are looking to become conservative, but I think the problem is that it's too late. You're basically buying insurance after your house is on fire. So I do think that I think it's important to have an allocation and stick to it for bulls and bear markets.
Okay, so a minimalist investor, don't go chasing too many funds and try and allocate it in a simple fashion. Before we get in, Suresh, so they're open in the conversation. Just a brief follow-up, Pratik, to you on what are you trying to say, or what are you trying to depict when you're putting out this risk return profile on the strategies front? There is a Nifty 500 TR index and a 5-year, 10-year, 15-year return versus growth plus gold or a moderate growth plus gold. Can you kind of explain this so that investors can kind of identify?
Yeah, absolutely. So, if you look at the returns of this asset allocation and more, I think the returns have been actually pretty good. So if you're looking at the growth investor, you're looking at, I think, upwards of 13 to 14%. And this is also on a rolling basis, which I think is extremely important. That takes out market timing in a big way. And whereas a conservative investor can expect anywhere between 10 to 11%, which is, I guess, a very good, if you consider that you're holding a lot less in equity. So I do think that, and I think the most important bit here is to compare the Nifty 500, which is a pure equity fund, with both of our portfolios, the moderate, the growth as well as the conservative. So just to give an example, the minimums go down dramatically. So if you look at some of the minimum and maximum between the Nifty, you can actually go down 8% or you can go up 67%. That comes down a lot with sort of asset allocated portfolios. In fact, with the conservative portfolio, if you're looking at it from, say, investing on a 3-year basis, what we've seen is that there's zero possibility of you making a loss, if you're a conservative investor. Whereas if you are a growth investor, there is maybe out of 4,000 different scenarios, there's maybe, I think, around 200 scenarios where you'll actually make a slight negative loss. Otherwise, you're making positive returns. Versus, I think, the Nifty pure equity product, where it goes up 10 times.
And Pratik, last question on this before we get in, Suresh. All of these are mutual fund backed returns. These are not essentially direct equity based investing. This is all happening via use of mutual funds.
Yes, absolutely. Yeah. So all four are mutual funds, all four are available. And obviously the underlying data that we've used is the index data. But yes, the investor can expect to replicate similar performance by using this minimalistic approach.
Okay. Now let's get in Suresh Tadagopan in this conversation as well. And the beauty about getting in Suresh in conversations like these is because Suresh, correct me if I'm wrong, but when you advise your clients, you are not your fees essentially is a fixed fee annually, and therefore it doesn't matter to you if the client is investing in a direct portfolio or through an advisor based for the non-direct portfolio. In fact, in your advices, you would actually be telling people to go in for direct plans because your compensations are anyways not linked to the investments happening through you.
Yeah, you are absolutely right. One small correction: it is not always necessarily a fixed amount of fee. It can be asset under advice based fee. But the second part which you said was absolutely right. I mean, we choose only commission free products. So in the case of mutual funds, it is purely direct funds. And even in the other products also, it will be commission-free products. So we are basically number one product agnostic, and we will suggest funds based on what is good from the client point of view. So it's purely client-centric, unbiased kind of an advice that we will offer. So from our point of view, whether they're investing in equity or debt or gold or anything is absolutely one and the same. We are not affected in any way.
Okay, now Suresh, a follow-up, and it's okay to differ with Pratik if you do, but here's the thing, right? Pratik Oswal is saying that go out, have a minimalist approach to investing even in mutual funds because there is just too much noise and choice out there, and maybe keeping it simple might be better for the head as well and for the portfolio too. What are your thoughts here?
No, absolutely agree with Pratik. Whether it is active or passive, keeping a small portfolio of maybe 8 or 10, including equity, debt, is always a good idea. Unless you have a portfolio which is ahead of maybe 5 crores, 7 crores. So maybe the number of schemes may be slightly more. I would not probably go only with one passive and one one index fund. I would probably, to diversify the fund manager risk, I may go for a passive. I may probably go only for passive as far as the large cap portions of the index are concerned. And I think there is still some juice left in mid cap and small cap, probably for some more time to come. But later on, again, probably there will be a case for passives, maybe a few years down the line. So currently, I will go for actively managed funds as far as the mid and small caps are concerned. As far as the Nifty 500 is concerned, I think again that's a wonderful product because it captures the entire market, and the entire wisdom of the market is actually incorporated in this kind of a passive fund. So overall, equity debt in a typical portfolio, anywhere between 6 to 10 is what I would suggest. Good diversification can be achieved by just 6 to 10 funds, both active and passive put together, is what I would normally go for.
Okay, there are other people who've given counters as well, and I would want both of you to weigh in on this. But just before I do that, Suresh, just a clarity, and we'll get to the other options in the other categories too. But as far as this Nifty 500, because there seems to be a consensus amongst both of you, what are the products available? Because I know Motilal Oswal as a house has a product like that. Are there other products available in the market as well? If indeed Nifty 500 based investing is a good investment, passive investing product.
I'm currently not aware of any other product which is as a fund of fund or a direct index fund. We do not want to actually put money into ETF. We have tried doing that. There are challenges as far as the ETF investing is concerned. The first among them is, the client has to have a demat account. Okay, and many of them do not want to open a demat account just for investing in ETF. And there is also availability of the product at a certain price. I mean, the sense ETF, though it is quoting at a particular NAV, it may or may not be available at that NAV depending on the demand. So we found that index is a better product. And as far as index products are concerned, the counterparty is a mutual fund. And from a liquidity perspective, liquidity is always available as far as a index fund is concerned. So we would prefer the index fund route. And currently, we are suggesting their funds only because that is the only fund which I am aware of, which is currently available in the index route.
Okay. Pratik, just one quick follow-up. So there are different schools, and as I said, after this, I would want to counter-question you both on this non-diversity part, but just a quick follow-up. So there are various schools of thought, right? There are some people who believe that there should be a lot of funds. Some people like Suresh are saying that they are doing a mix even within the equity piece, wherein they are doing maybe a large cap fund, which is passive, and mid cap and small cap, which is actively managed. You are saying that in your equity investing, Indian equity investment product, you are happy with just one category of fund, and which is this Nifty 500 fund. Am I getting it correct, Pratik?
Yes, yes, yeah. So I'm not debating on what is better or what is worse. Both are very different strategies. Both works for different type of people. I think I'm just talking about an alternative strategy which also works well. And if you look at the Nifty 500, it is a combination of large cap, mid cap, and small cap. It has maybe 80% large cap, maybe 15% mid, and 5% small. So I think you're getting some of that diversification there as well. But honestly, and this is obviously a very alternative approach. So I think this is only for someone who's not looking at going out there and trying to select between the hundreds of mid cap and small cap funds out there. Obviously, Suresh sir is very experienced, he's very knowledgeable, and I do think that this probably works better for the DIY investor who doesn't really have that much access to good quality advice. For that, it probably works to be maybe an alternative strategy more than anything else.
Okay, yeah, and well, viewers. So okay, let's put it this way, viewers. I think it's a pertinent point that if you are somebody who doesn't want to rely on an advisor, and you want to do it yourself, and you don't want the hassle of what's happening across into separate categories, and you want an exposure to the larger market at large, and not just large caps, or not just mid caps, or not just small caps, maybe a Nifty 500 index fund which captures the top 500 companies in the country might be a great option there. Okay, a fair call. Just one quick follow up, Suresh, and the arguments in stacked up in favor of having a smaller portfolio of funds are well known. There are people who believe that, as Jack Bogle probably said, and please correct me if I've gotten him wrong, but he said that if a fund has outperformed for 20 years, if I'm not wrong, I heard it in one of the podcasts, sell that fund because the next 20 years it will not do well. And therefore, there's no rule that the past performer funds will continue to do well. And therefore, diversify your portfolio because you do not know which fund in a given year will do well. And if you want to hold your funds for, like, say, 10 years, you can't definitely say that an X house, X fund will do well. So why not diversify a lot more? Suresh, any thoughts here?
Yeah, so before actually choosing a fund, you will have to do your homework, especially if you're choosing an active fund. In the case of a passive fund, there is no homework. I'm completely with Pratik. It is going to give a market-determined return, and it is essentially the wisdom of the markets. So, like he said, if you are a DIY investor, having a Nifty 500 is a good strategy. Even in our case also, we have Nifty 500 as a part of our portfolio for certain conservative investors where we do not want to give mid cap and small cap funds. So in a sense, we are giving large cap exposure, and we are giving a sliver of mid cap and small cap exposure through the market itself. Okay, so now diversification is concerned. We have to keep it at a certain level only, because as per research, it shows that beyond 5-6 funds in a portfolio, 5, 6, 7 funds in a portfolio, there is no diversification. There is only more and more chaos which comes into the portfolio. So if you want a bit of fund manager, then do that. But beyond a certain level, it only adds to the noise, and it does not add to any kind of risk diversification. So I would stay with a judicious mix of active, passive, or whatever else is required in a client's portfolio, including debt, international funds, and stuff like that. But not diversified too much.
Okay, fair call. Now, Pratik, there is a combination of strategies and the return profile that you guys have calculated as well. And I saw that table in your presentation. Whether we have it or not doesn't matter, but I still have it with me right now. And if I read it correctly, for a 5-year, 10-year, 15-year period, a moderate growth plus gold strategy works out well. Now, please just humor me here. I'm making a couple of assumptions that there is the viewer out here who's a DIY investor who's watching the show right now. And let's say that he's in favor of the moderate growth plus the gold strategy, because it's given decent returns if history is to be believed. Now, for that kind of an investor, I'm trying to marry your initial asset allocation strategy, which is domestic equity, international equity, debt plus gold, uh, through funds route. Is there
Okay.
a standard percentage allocation that you would probably allocate 50% to the Nifty 500 index, say maybe 20% or 10% to the international S&P 500 index, so on and so forth? Is there a standard rule, or again it depends upon individual investors?
No, I think what at least what we've done is we've taken us for moderate, we've done 60-40, which is standard moderate. So 60% will be in equity, and that will be a combination of, say, a domestic fund, which is the Nifty 500 and the S&P 500, and the 40 will be mostly debt and gold. Maybe gold will be a 5 or 10% allocation. So that's how we've basically taken it. What's really important is the importance of rebalancing. This is where most people get it wrong. I'll be honest, if you don't rebalance a portfolio, especially, so for example, most investors tend to do the opposite. When markets are bad, they tend to sell equity and buy debt. That is the opposite approach of what rebalancing means. It's actually the opposite. You have to make sure that your 50 or 60% allocation is sustained for a very long time, and you rebalance it every year or every half year or whatever it is. I think that is what the crux of how I would say asset allocation really works for the investor, and why it's important to continue to do it across market cycles.
What are the risks to such a strategy, Pratik? Obviously, the return numbers show that it is all hunky-dory, but any other risks?
Yeah. So in terms of risk, I think the biggest risk is behavioral. In investing, 90% is psychology and getting it right in terms of a strategy. So, for example, in 2009, when your equity portfolio is down 50%, 60%, and, when you have to rebalance a portfolio, which means, actually selling debt and buying equity, that is a very hard thing to do. And even in today's market, ideally, customers are better off buying equity and selling debt, whereas most people are doing actually the opposite. So I think that psychology aspect is what's extremely important. So I do think that, investors left on their own, do get this rebalancing thing wrong. So this is a big risk. And if this is not done well, will lead to obviously the strategy not working out. But apart from risk, I think the whole idea behind this asset allocation strategy is to actually remove risk. If you think about it, this portfolio that you see in front of you, it removes manager risk, it removes sector risk, size risk, geographical risk, also credit risk. That I'm using GSEX. So I think the whole idea behind this is to actually remove risk from your portfolio, and also and all of this being done at a very low cost, which again it's removing some sort of fee element as well. So I think overall that is what the highlights of this portfolio is. So the idea is more of de-risking than actually doing anything else.
It's probably a bit of a personal finance, a whole personal finance product done via the use of funds, if you will, viewers. So that may be a beauty of such a strategy. So if you actually believe in that, maybe it kind of does the trick for you. So there's just a quick counter question on that. For the set of people who are not able to time this, and I know that most people who are even mutual fund investors love to get that edge by trying to think that over a period of time they would want to do these calls themselves, because it's an activity. It keeps you thinking about the markets, and it's probably a good thing to do. But for people who don't have the time, they are working in a job, they don't have the time to take these calls of switching between equity and debt. Should they maybe also look at, say, a balance advantage category wherein the fund manager will take the calls of equity and debt? I think it's all triggered via some algos, if I'm not wrong, or percentage numbers, if I'm not wrong. Suresh, the question is for you.
Yeah. So as far as a do-it-yourself investor or a conservative investor, they can actually rely on index-based funds, especially if they want to do it themselves. The strategy which Pratik had outlined, that's a brilliant strategy. Now, as far as rebalancing is concerned, a do-it-yourself investor may not have may not have it in them to rebalance at a point when the market is really down. I would say at the minimum, what such an investor should do is at least not touch the portfolio, not take out the equity. The ideal thing, like Pratik also had shared, is to add sell debt, sell other things, and bring more into equity, because the equity allocation would have gone down, and you want to rebalance and bring equity back to the previous level. But if you are not able to do that, at least I would say in a situation like this, don't allow your psychology to undo your portfolio. At least stay put is what I would suggest to investors. even if they are not rebalancing the whole portfolio. That is what I would broadly suggest. Otherwise, a do-it-yourself kind of an investor is actually well off with a passive strategy, more of a passive strategy, and products like what Pratik Oswal has, because that actually takes care of everything that is required for an investor. It may not be absolutely fitting a person like a glove, for which you will require an advisor, but it is largely there. So it is not a bad thing at all from an investor point of view.
And comes at a lower expense cost as well. So that's actually an advantage.
Absolutely
so that's a very important. Okay. Well, viewers, just to sum it up before I thank our guests, the beauty about what we've tried to bring out today, and if you believe in that, that is, it's everybody's individual choice, that it also gives you exposure to multiple asset classes, Indian equity, foreign equity, debt, as well as gold. So that kind of takes care of the mix that you need in your portfolio at a lower expense cost as well. And from whatever little we've had a chat with all the experts in the last 3 months in COVID, everybody suggested that the geographical diversification is probably a very, very important thing that Indian investors need to learn. And I think this kind of takes care of that. So, gentlemen, both of you, thank you so much for taking the time out and speaking to us today on the Mutual Fund Show. It was pretty insightful for me, and I hope for a lot of DIY investors, it's insightful as well. And viewers, thanks for tuning in to this leg of the Mutual Fund Show.